Yes, hello. A new period, new situations, and new conditions for 2 and 2.5 years. We have been actually experienced this online life. Nobody would actually open their cameras, and you are actually instructing from behind the glass. Hopefully, this will change, and hopefully, we can have conferences that we can do face to face. I first of all would like to thank the deputy of the Union of the Turkish capital markets. I would like to thank the whole team for all their efforts. I hope that this organization will be fruitful for each and every one of us. And when we talk about micro perspective, we have valuable speakers. We know our instructors from different sectors. I'm going to be talking about as I have the opportunity to talk right now, and as I know that many people are going to listen, I'm going to be talking about what is the credit rating, the loan rating, and what are their actually contributions to the system. And then I will actually give the floor to you, honor speakers. Of course, this rating, the loan rating. Before we talk about it. Let me talk about a little bit about the company. We have been established in 2007, but later on, its joint venture situation has changed, and on the very broad area, having a 6% of also of the capital market. We have 26 partners in which Japanese partners are also involved, and also the stock exchange Istanbul as well. So we are we are talking about here structural products and structural different types of services. And our mission here is to develop the capital markets. And as for the as a company, we're trying to do any contribution that is possible. As we talk about the investors, the risk that is undertaken should be very understandable. There are symbols. As you know, we have alphabets and notations that we use. But in behind, there are hundreds of details that we have written down as documents. And this is a study that we are preparing for the investors. We are making in-depth analysis to our investors, and on the other hand, we talk about the quality differences about certain loans, and we give them the information how much risk they take, and according to the risk tendencies, their trends, we can give actually some certain estimations for the companies, and we have to talk about these matters for hours and hours. But once again, I would like to thank you for the opportunity to talk about it, at least briefly. So we are trying to help the markets, and the quality of the companies have to develop themselves in a certain level of equality, and that is the reason why certain documentations and estimations have to be, and follow-ups should be made. And in brief, for the investors, it is a very important quality criteria. And for us, for the companies, we need to attract the institutional companies so that we can actually improve their loan basis. And when we get into touch with the companies, with the institutions, then we have to be working in a very we have to be working from each other. It is a learning period of time. That's the reason why financial literacy is very much important in that matter. So we are actually speeding up that process with our experience, and structural financial techniques have to develop on the other hand, so that the companies can have alternative funds, and active passive terms and liquidity planning can be made. And as for the markets, there are certain companies, SMEs, that are not well known in the market, and we can provide them to come into the debting markets. And the SMEs, and on the other hand, unfortunately, there's plenty of academic studies that show as well that banks and branches of the banks and the SME banks branches, for instance, cannot be found, can be found in different provinces, in several provinces around the country. And hence the case, we are talking about such an ecosystem. And in the markets, for instance, adapting, we are creating financial supports, and it is actually giving advantages to the companies by giving some certain rankings and ratings. The risks and also the costs are also been calculated here, and the market. The company CEOs can actually give better decisions. In that case, on a national and international level, feasibility studies can be made as well, and all of them can be can create a company, find a way to be managed in a more productive way. And I believe that we are giving a great amount of a contribution to this. And the rating, the rating, credit rating that we do, is helping whether a company can actually be in an obstinacy or in a delinquency, for instance. So within this context, I believe that these reports can actually help companies to improve themselves, and the stakeholders can also be evaluated in that matter. According to apart from the formats of the reporting, a different type of a point of view, a specific point of view has also been presented. As for financial institutions, as for those who are giving the loan, the rates of interest are changing according to the risk factors. And according to the risk factors, we are giving actually a certain amount of orientation on how the companies can actually follow their own trends. And we are also creating an effectiveness for the companies. It is possible to actually create a trustworthiness with these companies without the support of a state if we make these analyses. Of course, everything that we do year by year and all the analysis that we have done so far is going to give a great contribution to the companies. Of course, the learning process and all the reporting process has to be operated immediately in a very fast manner. And the risk that has been undertaken is has to be analyzed. And right now, a new pathway has been initiated, which has been discussed for years, and we are following this new pathway that is going to be brought as an announcement soon. So we are, even though we are actually not giving an advice, but we are giving an immediate reference. And we are creating a standardization as well in each level, according to all of the parameters. Of course, the risk awareness can change. And that is the reason why at a certain standard, on an international standard, we try to bring up an opinion. There can be some speculative fluctuations, of course, and in securities. And this we are creating, and these estimations can actually create a better way of approaching to the steps to be taken by the companies. And on the other hand, rating. What types of actual contribution does the rating give to the economy? First and foremost, it can increase the trust to economy because you cannot actually the measure that is not known in order to overcome that uncertainty, of course, so that it can create actually a good pathway to see the trends, and the national markets and the international markets can be integrated with each other, and it can actually improve the financial effectiveness as well. As a result of this, JCR Eurasia as a sector on a micro and macro level, as for the operators, the sectors starting up from the sectors that they belong to, we are writing down certain ratings. In the last 2 years, this process, of course, has been also impacted by the pandemic. And we have also reported things that how how companies have been affected and impacted by this pandemic. Of course, depending on sectors, there are different levels of effect impacts. Hopefully, in the next future, we believe that there is going to be we are going to close the economic growth by 1.9% at the end of this year, we hope. And next year, I believe that we are going to be in a better situation. I know that I exceeded my time, even though I try to be very fast. But thank you very much for giving me the opportunity to talk to you. Thank you very much, sir, for your speech. Indeed, it is not possible to actually to talk about these matters in a very short period of time, but thank you very much for your contribution. And now, first and foremost, I also would like to welcome each and every one of you. And I'd like to introduce you to our speakers in the studio, at least, who are physically with me here today, are Gizem Öztok Altınsaç from TÜSİAD, Chief Economist, and Professor Dr. Erhan Aslanoğlu from Imperial Reis University, Vice Rector. By the way, I am Selim Yazıcı from the Turkish Union of Capital Markets. I am the Deputy Chief, and I'd like to also introduce you Ms. Ceyla Pazarbaşoğlu, IMF Vice Director, and Michael Taylor from Association of Chartered and Certified Accountants, Chief Economist. And warm welcome to you. And now, I will like to make a small introduction. The speakers can talk more about this theme.
İnşallah post olur.
We are talking about post macroeconomy. Hopefully it's going to be post, because still we are in the COVID period, and from time to time we can hear the increase on the cases and the lockdown news, but we are trying to see the future. Hopefully next year is going to be the last year, and it's going to be the post-COVID era for us. It's been 2 years as of the end of 2019. It's already appeared, and when on March in 2020, it was disseminated all over the world. And we understood that the countries in the world are very much connected to one another. And maybe 4 years, we've been talking about ESG issues, and we understood their importance. And we had even further interesting things, some failures or pauses on the supply chain, and maybe we were in some dead ends, and the reaction of the countries was very different from one another. All the political actors and the policymakers, legislators, and also industrialists, everyone got affected. For instance, in the UK, there was this different approach in the beginning. Then they changed their reaction approach, but nobody let it go, let it find its way. So from the macroeconomic perspective, I think it was an invaluable experience. So it was like the box of Pandora. We saw certain things that we hadn't seen before. And for instance, in the United States, there was an increasing number of financial aids, and also central banks' balance sheets expanded. And at this very point, we can also see the effects of the previous happenings. Everyone in the world is talking about inflation, whether it is permanent or not. Now I'll give the floor to Michael, and I'd like to ask him this question, especially in the developed countries' perspective. These inflation discussions, how can you evaluate these inflation discussions? Is it really temporary, or else is this going to create permanent effects? The floor is yours, Michael. Thank you.
Hear me? We can hear you now. Okay, hello everyone. It's a great honor to be speaking to you today, albeit virtually from London. Yes, as mentioned, the big issue, one of the big issues, as we hopefully do come out of this pandemic, is in developed markets, is inflation now going to be a permanent feature of the global economy, or is what we're seeing just a temporary blip? And debate rages on among economists, as ever. Economists never seem to agree on much, and this is no exception. There are a range of views on this issue. But first of all, let's just clarify just what the situation is right now. I've chosen obviously the Euro area, the US and the UK as representative of developed markets inflation. And as you can see, inflation has picked up very sharply in recent months. It is over 3% in the UK. It's now over 4% in the Eurozone. And remarkably, it is 6.2% in the United States. Now, that is the highest rate for 31 years, since 1990. Clearly, really significant jumps in inflation over a very short period of time. So what's going on? I mean, the explanation for why inflation has jumped so quickly is relatively straightforward. Obviously, last year we had the collapse in activity, demand collapsed, commodity prices fell, inflation disappeared. So inflation was exceptionally low. But since then, of course, lockdowns have been lifted. And I think what has taken a lot of us by surprise, and I would include myself among that, is that demand has come back exceptionally strongly as lockdowns have been lifted. Pent-up demand that was stored up, in particular by the policies that governments pursued. In the United States, there were big transfers to households, generous unemployment benefits, checks sent out to just about every household in the United States. In the UK and the Euro area, it was more government basically paying people's wages, though they were staying at home. So incomes were very much supported. Spending was clearly restricted because economies were in large parts of the economy was simply shut down. You couldn't spend out. You couldn't go to restaurants and hotels and bars. But then as lockdowns have been lifted, that demand has been unleashed, and it has come back exceptionally strongly, and to such an extent that supply basically has not been able to keep up with that extra demand. So excess demand, limited supply, prices go up. And this chart just shows a few examples of that. I guess there are two on here that I would draw your attention to. The chart line tracked against the right-hand axis is shipping costs. Now, shipping costs have absolutely shot up over recent months, and cost of taking a container ship from China to the West is now around about 5 times the level it was before the pandemic. There are various reasons for that. The basic one being the demand, but also there have been port shutdowns in China, etc., which have exacerbated the situation. So shipping costs have contributed to rising costs and prices across many goods. Oil prices, of course, which fell sharply in 2020, since roared back by about 50-60%. And that has obviously also feeds directly into higher prices. So, for example, gasoline prices in the US are now 50% higher than they were a year ago. That is clearly a big contributory factor to higher inflation in the US. And then there have been another factor. I'm sure you're familiar with this, the semiconductor shortage that that is now in existence that has actually had quite a big effect on car production. So car production globally has been hit because semiconductors are simply not available in the desired quantities. And the effect of that has been to shift demand to used cars, and that's pushed up used car prices. That has contributed to higher inflation as well. In, for example, US again, up about 30% year on year. So you can take, these one-off factors and quite legitimately say, well, these are temporary factors caused by the shifts in demand and supply as a result of the pandemic. And as they work themselves through, then inflation will come back down. It's high at the moment, but it's temporary. We'll see inflation heading back down during the course of 2022. And that is actually the view I would suggest held by perhaps most economists at the moment, and indeed a large number of central banks. And of course, none of the central banks here, US Federal Reserve, the Bank of England, the European Central Bank, have actually done any active tightening of policy so far. They are all sticking to the view that inflation will come down next year, although increasingly they are making noises about concerns about inflation. And I think there is a good reason to be concerned about inflation being a bit more of a permanent issue. And sort of a monetary story, really. This chart shows the growth rate of broad money, so the total amount of bank deposits, basically, notes and coins, but bank deposits in circulation. And what this chart shows is, as the pandemic hit in March last year, you see the central banks, as they quite rightly did, basically threw everything at it. They cut interest rates, and they started so-called quantitative easing, that is printing money and buying assets. And that boosted, obviously, the money supply, supported confidence and helped avoid what could have been a much, much worse economic situation. As economies have recovered, these growth rates have slowed a little, but they are still very strong. There is still an awful lot of monetary stimulus out there. Not surprising, given that the central banks basically still have more or less the same policies they introduced back in March 2020 in place. And this suggests that there is a risk that even when all these supply issues are sorted out, and yes, there is some easing of particular price pressures, underlying demand is still very strong and will maintain upward pressure on prices, and inflation will stay higher for longer. And I think finally, there is another reason to be concerned, and that is the labour market. I mean, the classic way inflation sort of gets into a system is prices rise, wages respond to those prices, and then prices get pushed up again, and you get what we call a wage price spiral, and that leads to a sustained increase in inflation. This chart just shows vacancies that are currently in existence in the chosen the US and the UK data here. And obviously these are close to record levels, suggesting that there's a relatively tight labour market. Obviously, various things have happened to labour markets during the pandemic, so it's not so straightforward to say that labour market's tight, wages are going to start rising, and that will quickly lead to a wage price spiral, because a lot of these vacancies are in sectors that were particularly badly affected by the pandemic, hospitality and retail. So there may be some reluctance among people to go back to those jobs whilst they're still concerned about the COVID, etc. But there's certainly increasing evidence that the labour market is overall is quite tight, and there is some evidence of a pickup in wages in the US and the UK. And if that were to sort of develop into a much more widespread increase in wage growth, not justified by productivity, then you could be on the verge of a classic wage price spiral. And then you really do have to, central banks really would then have to start catching up and start tightening policy quite aggressively to prevent a really serious rise in inflation rates. So I do think there is a significant risk of sustained higher inflation over the next 2 to 3 years. There was a headline in the Financial Times today, actually, that said everyone is worried about inflation except the bond market. So I would actually just finish by saying that despite the concerns that consumers are expressing and that politicians are expressing, etc., so far the financial markets, in terms of the bond market, bond prices, barely budged. They're still buying into the transitory rising inflation and everything's going to be fine. So if you believe in the bond market, then there's absolutely nothing to worry about, but I'm not so sure. So those are my comments just to start the discussion.
Much, Michael. We'll get back to you again. Michael'ın hani söylediklerinden anladığımız.
I would like to thank you very much, Michael. And this is what we also understand from your speech, that we can't get rid of this inflation issue very soon. This is what we unfortunately understand. And Ceylan is in the United States, and Ceylan is going to be also talking about the changes in the USA, because what is going on in the US is directly affecting the developing markets, developed markets. So what kind of an effect is going to be received for our countries about this Fed developments? There is a tapering, as you all know. Is it going to be a new tapering process, different from 2013? Because the US dollar, I mean, is it going to be even stronger against all this inflation and the packages which have been explained?
Teşekkürler.
And thank you very much once again. I wished I would be in Istanbul. Unfortunately, I cannot be with you, but at least I can be here online. We're talking about very important aspects, of course, in general. I'm talking with you in these congresses in English, but well, I'm going to be talking in Turkish. However, I'm going to use some English terminology as well. As Michael has said, there is a great amount of an uncertainty about inflation pressures and real estate and energy price increases, and the differences between states, digitalization. So what we call as for structural transformation is definitely a period of time that we are facing during the pandemic and post-pandemic. And that is definitely affecting the developing countries. Michael talked about the developed countries. And of course, the developing countries do have a great amount of a debt they have to undertake. And that has also been reported by IMF. And of course, the developing countries do have some certain packages that they have support packages. But on the other hand, there's a great amount of a debt they are under pressure of. But not only about the interest rates are rising, but not only about that, the way of communicating is also an important issue. During the summer and also beginning fall, there is a downsizing talks going on, and values have been decreased. And the G20 summit has been made in Rome, and the central banks, on the other hand, particularly in the developed countries' central banks, they were talking about the communication that we have to make in collaboration for the future. So this is very much important for us. As for Fed, FOMC is decreasing the asset buying, so purchases, but the United States inflation pressures and also the energy price rises is regularly increasing. Of course, they said that they're going to be patient in announcing the rises of prices. So in real and monetary markets, capital markets, there is a great change that is going on right now, and that definitely is really worrying us as IMF, because there can be sudden changes of expectations as well, and that can actually create surprises in inflation. And during October, we have a report, World Economic Outlook report, that has been published, and the United States is growing, which is an actual positive impact on the globe. And partially of this, of course, more rigid economic conditions can be balanced in a way, but of course the uncertainties are ongoing. So what can go wrong? And the high risk scenarios were checked out, and our global financial stability report has also been just published by the end of October. And taking a look, the whole high risk scenarios are about, if the inflation rises, then all the inflation expectations in the United States can change, and that can cause an earlier rise of prices. So even though we have these packages that is accepted right now, there will be a slower growth. And these negative shocks in real estate, for instance, in China, and high rising capital markets can create some certain crisis. Of course, the United States dollar is becoming more valuable in developing countries. So higher inflation and also foreign currencies pressures can be faced. If these risks occur, of course, then the positive trend can have a bad impact, and that is the reason why the states have to be aware of this, and they have to take steps accordingly to this. And we were talking about the G20 summit. Very important debates have been undertaken, and even though it seems like there are actually very big differences between countries. For instance, all the subvention measures that have been taken by the states, and all the monetary measures or interventions have been taken in the countries developed, is at about 20% of the GDP of their countries, and in the developing countries it is at about 6% of the GDP, and in the underdeveloped countries, it's actually at 2%. So all the packages that countries have received is differing country to country, and that is really very much affecting how the countries are going to overcome the pandemic. And the macro policies have to calibrate it very tediously. So 4.5%, if we can actually be more precise, and if we can go forward in a more positive way, then there will be an increase of 4.5% of the developments, and some certain structural changes can be made by certain countries indeed. And the countries that can make these structural changes can definitely get more benefit from the interest rates, or from any other monetary and financial interventions. Well, it seems likely to be that we cannot have a deep breath and at a closer stance, as far as I can understand. So let me give the floor to Mr. Erhan. So he's going to be talking about the Turkish situation that we are not foreign to, or we are not very much foreign to inflation. Of course, we have survived very inflationist situations and conditions, but somehow we have found our ways in those periods of time as well in the past. Has there anything changed so far? Within the light of what Michael and Ceyla has said, what will be the reflection of what's going on in the state? Was it the worst that we have faced, or is it going to be worse?
Thank you very much. it's become a tradition each and every year. This organization has been conducted very successfully. I'd like to congratulate you, the Union of Turkish Capital Markets Board. I'd like to congratulate everyone. And yes, when we talk about inflation, we are a country which is very much accustomed to having inflation. But in the beginning of 2000, we had this inflation period. Dollarization decreased, and also enhancements on the expectations. We had this process as well, but unfortunately, after 2010, after having this horizontal level, after a couple of years, the inflation picture again was rising. Our target was 5, but we could not reach to that in the last couple of years. Unfortunately, we were even going further away from that 5% inflation percentage. It was very volatile and very high levels of inflation. And currently we are at a very high point. So what are the dynamics which are increasing the inflation? When we have a look at the answers to this question, we can see that these factors, by the way, are still vital. They are still alive, and we can feel the effects. And there is also the imported inflation coming from the global arena. The situation gets even much more complicated. So in short, why we couldn't hit the 5% inflation rate, and it seems like it's a dream for us. Why we come to this very worst point? There is this increase on the foreign exchange rates, and in the last years we have had this devaluation of Turkish lira. Value of Turkish lira has decreased enormously. For that reason, inflation has increased up to that point, and also it has this double Y effect, and the permeability of the foreign exchange rates do increase as the inflation rises. So this effect in this period that we are even in the last 2 months, has shown its repercussions. And the second issue is that we use too much imported goods. We are dependent on other countries in terms of energy. So for that reason, price increase on commodity in the world, energy price increase in the world have direct effect on our country. And this year we have felt this very much. And in the upcoming periods, it seems so that we are going to feel the same thing. Of course, it's not going to be at the same speed, probably. Energy prices will be again high. Maybe main metal prices will be decreasing with the enhancement on the dollar. But there is this issue with respect to food, especially agricultural products, agricultural commodities. All around the world, we have experienced the highest increase on the prices in the last years. And we have had the high inflation in food as Turkey. It's related to production, competition conditions, distribution of the food. Everything could be affecting the food inflation. Unfortunately, we are rather are interested in the results, not the root causes. That's why food inflation is increasing, and there is pressure over the food prices, and inflation of food is generally shaping the economics in Turkey. And unfortunately, the expectations are affected very adversely by this increasing inflation. To give you an example, this year, after having these figures from currently, we are talking about 36% of the producer price index. So maybe it could be decreased, but we're talking about 36. And when it comes to inflation, central bank says 11%, but maybe official target was 5 to 7%, but 36. It is the new reappraised value. So most probably like bridge prices and also highway passing prices, we've seen that maybe it's not going to be 36% or 30%, but it's going to be 25%. So this kind of price increases, in addition to inflation increase on the consumer side, on the producer side, create certain expectations. So people might expect that this year inflation will be about 35% because last year it was 25%. So there is this adapted expectation perception of the consumer and producer side. And these expectations are also shaping the reality. As inflation increases, as I've stated beforehand, we are on our way with adapted expectations. We are talking about 20s, for instance, 20%. So we might think that it's going to go on with 20%. But we adapt ourselves. If we look at the expectations questionnaire, we see that our expectation or else our forecasts for the inflation in the future is going to be 30-35, and competition conditions in Turkey. I'm not going to generalize each and every sector for this, but there is this brand pricing. There is this high pricing tendency in the high inflation rate due to lack of competition. This price increase is much more triggered. So again, main factors determining this situation is again showing us the probability of increase in inflation will be continuing. And when we have a look at the producer price index and consumer price index, we can also understand that the commodity prices and some prices of the items again will increase. So our inflation rate will be about 20 something in the future. We'll see it together. If we have more time at the end, we'll discuss this. But one of the main actors in terms of this reversing this forecast or expectations is the monetary policy of the central bank. So it's the, of course, most influential element for shaping the economy in general. I'll stop here. Thank you very much. You have touched upon great points. The inflation in Turkey has not been broken at all. I mean, even its best times, it was like 8%. So it has its own psychological inflation, maybe it's already 8%, and it's now going up. So you have also mentioned the forecasts and the expectations of the people again, say that it's going to increase. I'll give the floor to Gizem. Ms. Gizem, what are your opinions about Turkish struggle against pandemic with its economic measures? Were they correct? Because we hadn't recession in 2020 and in 2021 we did certain things and we are still talking about high growth numbers. Were these correct or not? What can you say?
Tebrik ediyorum TSBB'yi.
Well, thank you very much, and thank you to all the organizers. First and foremost, we have to see what we have to do. So the major central banks, and at least the G4, had different approaches compared to us. And the financial areas, they were actually broadening up, but from $20 trillion, they have reached up to $30 trillion in the G4 states. Turkey, instead, pressing up more money, was giving a lot of more interest. While giving an interest, so giving a great amount of a loan impact at that period of time. With that impact, the money circulation has been increased. Circulation of money has increased. So they try to actually revive the system. As this happened, of course, our model was based on a foreign capital. And that's the reason why when you start giving interest rates below the inflation, unfortunately, the risk premium has been increased and the foreign currency started to rise up. Complementary to this, we use the reserves of the central bank. So the loan demand, you have actually grown up, but there are two results of this. One is inflation, and the other one was to the loss of the central bank treasury. So rather than actually do So you have actually a loan coming from foreign currency and you're consuming it. So this is the way you're growing up. And so there's no change right at the moment. And on the other hand, there's also an economy just like China. And now we have to ask this question as such, why we are taking steps as such, was it sustainable, or were the steps taken was much more as a cost and as a result? This year, on the other hand, of course, whenever there is a demand of loan, for instance, it happened in the end of 2017, of course, when you rise up the inflation, then there is actually an increase of interest rates, and also there has been a slowdown and downsizing in loan demand. And what we call about this carryover situation, we have grown up at 9% because the private sector has made an investment. That was the domestic situation. And the growth in Europe was really good, particularly manufacturing in Europe was had a record, was really good. And when we all combine them together, there has been actually a 9% of a growth in the end of the day. But of course, I'm talking about the manufacturing point of view in this matter. And then, taking a look to the last 3 months, there has been a very obviously, there is a negative credit increase. So finally, it happens to be that, yes, there is a 9% of a growth, or we are close to 10%, doesn't matter. Is it sustainable? So that it is sustainable, we need to have a resource. And there are two conditions for this. You either have to find an investment from or a capital from abroad, or you have to do it within the country, within the country's conditions. Now, in such periods of time, when you find actually a capital from the outer countries, there is a possibility that you do not want to actually make any kind of a transaction within the country. But now in Turkey, for instance, yes, there is a positive growth in Turkey, but the cost of it is unfortunately is a loss of confidence in the economy, and of course the high inflation, and the citizens cannot actually spend too much right now. Now, there is an 8% of an inflation that we have left behind. So this is actually a story that started up in 2008, and then we were reached up to 89%. And with the reviving of economy, actually Turkey has started up in a new situation. There is a structural breakdown right now, and it is that the inflation cannot decrease down to 20%. When the inflation is so high in a country, as in the Lagarde's speech, one of the most important things that there is a doubt here, of course, when there is a high inflation right now, but when there's such a suppression and the economy is very slowing down, and when there's also an inflation, then the next step is not only the supply and demand, the supply and also demand will actually get hurt from it, even though temporary right now. As for expectation, it can be actually permanent, and then a structural transformation can be realized, and then it is hard to control it. The situation right now in Turkey is we are importing inflation from abroad, and unfortunately, due to the demand of loans, there is a great of an inflation as well. And last year, for instance, there has been we could actually provide lower loans with high loans with lower interest rates. But now we have actually decreased the interest. This is actually a cost for us that returns as a high inflation, and that can exceed to 20%. And right now we are shifting to a rising inflation. Now we are talking about expectation that can be adapted, but right now in Turkey there is a very clear, if you make a clear mechanic calculation right now, of course there will be a permeability in the foreign currency. But as Mr. Ercan said, in the inertia situation, that means that the next step of of the inflation is a higher concern right now, and there is an actual slowdown in manufacturing in the European Union, and the next 6 months and our exportation compared to the previous 6 months will be slowing down in domestic demand. As for inflation, unfortunately, when we make a calculation, there will be a very severe suppression in the domestic demand, and right now there is loan demand, and you know it very well, of course. The loan interest rates, there is no actually kind of a calming down right now for the next coming 6 months. So any step you take right now, yes, it has made us grow up, but there have been plenty of side effects on the other side. Maybe in the next coming years, the situation that of growing up will be not sustainable, and that also cause a damage of actually of purchases by the citizens. Thank you very much. And Ms. Jayla, as I have catch you up, I would like to ask you another question. It's not easy to get connected to you, but you have undertaken very important duties. You have been working in the board of advisory boards as well of the, and you have undertaken also duties in BRSA as well. From the point of view of banking, what do you think? By the way, it is a hot issue right now from the banking system. That we are hearing lots of good news on the other side. What is the importance here of the banking system? Because you know the Turkish banking system very well. Can you just please just talk a little bit about this?
Tabii,
Well, yes, there's this echo. Okay. I'm going to be talking about developing countries, including Turkey, but I don't want to give you too many details about Turkey. Between 2002 and 2013, many reforms were made in banking sectors, restructuring, and also capital package. They were realized, and important regulations was also fulfilled. And I think those reforms empowered banking sector, foreign capital, and also know-how. They were made available in our country, and very valuable reforms were made. But it was previously mentioned, there is this effect of the inertia. So this is very crucial, and including developing markets, emerging markets, this is what we see in many economics. In the pandemic period, banking regulations, financial regulations, were a bit loosened. So these also made financial conditions be in line with the economy, and there was cash flow to the economy, and it prevented shock being even much more aggravated. But one of the important things is that this regulative loosening is, of course, loosening some financial things, but in terms of decreasing capital needs, we need more strict financial aspects, because if financial institutions take more risks, if they are like acting loans to the zombie banks, the bankrupted banks or institutions, then these financial conditions can be said they are even much more strict. And I believe that the real effect will be even more visible when this situation is over, whether there's some unknown situations in public banks. And maybe in the future, there will be another wave of bankruptcy. We don't know it yet. And also, these bankrupted zombie companies rate, will it increase in the future? These are very important topics, because in the upcoming days, we will be much more affected by these situations. Institutionally and sectorally speaking, we know that there is a close relationship, and health is affected by this. And in the emerging, developing markets, we had many crises. We learned a lot from those crises, and those experiences led to increase on the talents and information of the companies and also the banks and BRSA, Banking Regulatory Authority in Turkey, and also Turkish capital market boards, they have huge responsibilities and roles in terms of maybe teaching the previous lessons. So it's going to be much more critical. And in the developing markets, as we have mentioned, we have huge financing needs. We need huge financing support, and monetary policies and also inflation concerns are very huge. So on the capital flows, there could be certain changes, and there is this climate change and cryptocurrency accumulation. So there are many big changes. In order for us to get benefit of these changes, banks and also capital boards, capital market boards, their importance is increasing enormously because they have big potential. And there could be certain regulations, and if those regulations are effectively used and applied, certain problems could be solved much faster. And Turkey and some other developing countries have experienced due to their own past, so they could take more precautions, and maybe we can get rid of or prevent ourselves getting into more crisis situations. Thank you very much. Now I'll ask my last question, and I'll need very brief, short answers. And maybe we can start with Erhan and Gizem. Let's say it's now next summer, let's say, and there is this herd immunity. So we are not thinking about pandemic, and there is no ban on travel, etc. So if there's something permanent out of it, I mean, economic wise, what will it be? What will not change in our lives economically? Okay. I wish that there's not going to be any permanent effect of this pandemic in our lives, but this hybrid issue, I guess, we will have this hybrid issue one way or another. It will be permanent in some sectors, especially as a person, as a professor working in universities. This is what I feel. Education is going to be very affected by these technologies, this online class lecturing, these online lessons, concept of lecturing in universities and also access in all over the world will be affected. This is two important points I'd like to mention. Well, maybe I can add this. Actually, this pandemic and virus, yes, changed certain things in the economy. Maybe world will be having 3 to 4% inflation rather than 2%. It's going to be permanent. But beyond that, when we are in summer months of 2022, in Turkey, in other countries of the world, we will be having food as the real problem. It's going to be a problem. I hope I will be wrong. Yes, this is very crucial. It's been also a hot debate in our country. Thank you very much for touching that. Michael, what do you think?
Pandemic.
Thank you. Yes, well, I would agree with a lot of what has been said already on that. But I would, first of all, yes, I think inflation will be trending 2 or 3 percentage points higher post-pandemic than pre-pandemic, maybe even a little bit higher than that. On a more positive note, I do think there is a chance that productivity, global productivity, output per worker may actually get a boost. Believe it or not, as a result of this pandemic. Obviously, after the global financial crisis of 2007 to 9, productivity growth throughout the world, but in particular in advanced economies, has been very poor. I think the shock of the pandemic, I mean, we've seen the rapid adoption of new technologies. Retail sales, for example, have gone suddenly 40% online in the UK from less than 20% before. That's been a permanent change. And obviously the teaching online, doctors' appointments going online, the ability to work from anywhere. For example, in the UK, London obviously is hugely more expensive than anywhere else to live in the country. But in future, if you can live in the north or southwest of England, much cheaper places, that will lead to a sort of equalization across the country, a leveling up a boost to productivity across the board. I think that could happen not just within the UK, but actually within the world. People in emerging markets can provide services into developed economies online. So I actually think, yes, there's an inflation worry, but I think there is a positive aspect to this, in that the pandemic has forced like 5 or 10 years change to be adopted within a few months. Those changes are looking as though they are permanent. And I think on the whole, they will be beneficial.
Thank you, Michael. Good to hear this. Ceyla Hanım, son sözü size vereyim.
Ceyla, I'll give the floor to you, and we'll finish. What will be the permanent remaining thing for us after the pandemic? Is this question for me? Yes, for you. Digitalization. This is what I'm thinking right now, especially on the private sector and on the financial sector, digitalization, and also how to increase opportunities on the digitalization. This is something important for governments, and there will be challenges. How to fight against those challenges? Governments should define their policies, and globally speaking, multilateral policies must be determined. Coordination is very important, and we have to increase these positive opportunities. Well, thank you very much. I really enjoyed this panel. I hope all the participants and audience have enjoyed us. Michael, thank you very much for joining. Ceyla, thank you very much for participating. It's a bit early, I guess, for you, but thank you very much for joining us. Erhan, Gizem, thank you very much. And yes, once again, I'll thank